Hi, I'm Tom Seifert, Senior Advisor here at Fairport Wealth. Today I'm going to take a few minutes to attempt to outline some of the more impactful provisions of the new Secure Act 2.0. Included in this year's federal government spending bill was far-reaching legislation relating to our retirement system. The bill attempts to strengthen the system and Americans' overall readiness for retirement. Over 90 some provisions in all. This new law, signed into law at the end of 2022, is referred to as Secure 2.0. As a side, it's amazing what Congress can get accomplished when they want to head off for their holiday breaks. This was no small feat. This new law is a follow-on to the initial Secure Act that was signed into law in 2019. The new provisions impact how you save in and withdraw money from your retirement accounts. If you're all curious as to what does the acronym SECURE stand for, it stands for Setting Every Community Up for Retirement Enhancement. A lofty goal and a mouthful as well. Before going on to Secure 2.0, let's take a moment to list a few of the major items from that initial 2019 bill. It changed the age at which retirement plan participants need to take required minimum distributions, I refer to that as RMDs, from 70 and a half to 72. It allows traditional IRA owners to keep making contributions indefinitely, as long as they are working and there is earned income, that is. Mandates that most non-spouses inheriting IRAs take distributions that end up emptying the account within 10 years, doing away with the so-called stretch IRA. Many part-time workers became eligible to participate in employer plans, and it allowed for annuities to be purchased in 401k plans. So those are some of the major items from that initial bill. Almost as soon as the 2019 Secure Act was signed into law, lawmakers were working on clarifications to the law, as well as putting together the framework for a second add-on bill for congressional consideration. The result, after much negotiation and compromise, is the Secure 2.0 Act. As stated earlier, this new legislation was signed into law by President Biden on December 29th, 2022. As part of the 1.7 trillion 2023 fiscal year spending bill. It had broad bipartisan support and will have an immediate impact on one's retirement savings and income strategy. Not only are individuals affected, but also businesses, the retirement plan, and plan administrators themselves. It should be noted that the effective dates of the new provisions vary, with some effective immediately in 2023, while others will begin over the next few years. Also, some of the rules are mandatory, while others are optional for companies to consider and potentially include in their retirement plan provisions. The areas that Secure 2.0 change relate to required minimum distributions, the allowable contribution amounts, charitable distributions from IRAs, and many changes are meant to help younger people and allow people to save for emergencies within retirement accounts. I'll briefly go through these changes in the following slides. First off, there are changes to RMDs. The current age requiring distribution is age 72 and is now pushed back a year to 73. This age is further increased to 75 10 years from now in 2033. So, if you were born after 1960, your RMD age will be 75. For those born between 1951 and 1959, you'll have to start withdrawing from your retirement accounts at age 73. This increase in RMD age will provide for more years of tax-deferred growth and allow for additional distribution planning around tax bracket management, and perhaps implement Roth conversion strategies before actual RMDs are required. Further, starting in 2024, Roth accounts within employer plans will no longer be subject to RMD requirements. Once again, these are Roth 401ks. Currently, these Roth 401ks required RMDs if a participant was 73 or over. This is a welcome change for those not rolling over their employer plans to IRAs. Further, penalties for failure to take RMDs are reduced to 25% from the onerous 50% that was in existence, even lower to 10% if promptly corrected when an error is realized. Another change effective in 2024 is that a surviving spouse can elect to be treated as the deceased spouse for RMD requirements versus making the retirement account their own. This election makes sense to be made when the deceased spouse is younger than the surviving spouse, allowing for a delay in taking required RMDs, further allowing for tax-free compounding or tax-deferred compounding. There are also many changes regarding the allowable funding of various retirement plans. I'll mention a few. Beginning in 2025, retirement savers ages 60 to 63. You can see all these dates and ages that there was a lot of compromise, but retirement savers ages 60 to 63 will be allowed to contribute the greater of $10,000 a year or 50% more than the regular catch-up amount to their workplace plans. In 2023, the catch-up contribution limit to these company plans for the broader population of those age 50 and older is $7,500. So, by way of example, assuming the catch-up remains at $7,500 in 2025, for those then age 60 to 63, they would be able to put in a catch-up of $11,250, which is 150% of the $7,500 versus just the $7,500 catch-up. These catch-ups will be increased after 2025 and indexed for inflation. There is a wrinkle, however, is that if you earn more than $145,000 during the prior year, all catch-up contributions will need to be made in after-tax dollars, which means non-deductible and in a Roth after-tax basis. Beginning in 2024, the current $1,000 catch-up contribution limit for IRAs versus the company plans I was just discussing, those 50 and older will be indexed for inflation, and as such may increase every year based on cost of living adjustments. Beginning this year, employer-sponsored plans can provide plan participants the option to receive company matching contributions on a Roth after-tax basis. Under previous law, matching in employer-sponsored plans was allowed only on a pre-tax basis. Having said this, employer plans will have to be amended to offer this, and payroll systems will have to be reconfigured as well. So it may not be an immediately available to participants wanting to take advantage of this new option. This election could make sense for younger and or lower wage individuals for sure. Under Secure 2.0, effective in 2025, automatic enrollment is required of most major employers. The starting contribution rate must be of at least 3% of an individual's income, but no more than 10%. Also, the law provides for annual increases of 1% up to a maximum of 15%. Employees who don't wish to participate in the plan must affirmatively opt out. There are exceptions to this automatic enrollment mandate, such as businesses with 10 or fewer workers and companies in business for less than, say, 3 years. It should be noted that current existing plans are grandfathered from this mandate as well, but employers may well include these automatic enrollment provisions in their plans. This will significantly encourage otherwise reluctant savers to begin accumulating retirement assets. There's some new rules for qualified charitable distributions. Under current law, individuals age 70 and a half and older can direct up to $100,000 in distributions per year from a traditional IRA to qualified charities, satisfying all or part of their RMDs as well. Effective in 2024, see, I told you about all these varying effective dates, but I'll continue. The amount will increase based on inflation rate, meaning it may increase every year based on the cost of living adjustments. In addition, beginning this year, 2023, individuals have a one-time opportunity to use a qualified charitable distribution to fund a charitable remainder trust or a charitable gift annuity. Up to $50,000 indexed for inflation can be directed to these vehicles using this one-time distribution option. This is basically an expansion of the type of charity or charities that can receive a qualified charitable distribution. Contributions to a split interest entity benefit not only the charity, but also the individual IRA owner. A split interest entity, i.e. charitable remainder trust or gift annuity, can generate an income stream to the individual IRA owner for a selected term of years, not exceeding 20 years or their lifetime. This gives the donor the ability to be philanthropic while at the same time providing an income stream during retirement years. I could see one using this opportunity for a charitable gift annuity, given its relative ease and the charity itself administering the annuity. The remainder trusts, not so much, given its complexity to establish and the ongoing administrative burdens. A few provisions are particularly relevant to younger individuals. Secure 2.0 allows excess 529 funds to be rolled over to a Roth IRA, tax and penalty free, beginning in 2024. Specifically, beneficiaries of 529 college savings accounts can now roll over up to $35,000 over the course of their lifetime from any 529 account in their name to their Roth IRA. However, rollovers must be within the annual contribution limit. So how does this work? Let's say a 529 plan has $25,000 excess in the account, and the beneficiary is less than 50 years old. Therefore, the current annual Roth contribution limit is $6,500. As such, the 529 beneficiary could transfer $6,500 from the 529 plan to their Roth IRA annually until all $25,000 excess was moved. To qualify for this tax and penalty-free rollover, the 529 account must have been open for 15 years and no contributions made in the previous 5 years are eligible for rollover. The issue remains that it's the parent, not the child, who are the ones trying to balance retirement and college savings. As written, the law only allows the beneficiary of the 529 plan to roll over the excess into their own Roth IRA. And the language indicates that changing the beneficiary of the 529 plan restarts the 15-year clock. However, language in the Secure 2.0 Act summary documents seem to support the idea that these rollovers should be eligible for parents as well. This hopefully will be resolved between now and 2024 when these rollovers become available. Regardless, this rollover provision should alleviate the overarching concern that money placed in 529 plans will be trapped if ultimately unused for education, whereby encouraging greater savings for both education and potentially retirement too. A provision of Secure 2.0 that takes effect beginning in 2024 will allow employers to make contributions to workplace savings plans on behalf of employees who are still repaying their student loans. This isn't mandatory, but an available permitted option. You know, it's not unusual for younger workers saddled with student debt to forego retirement plan contributions to continue to pay off college loans. Under the new law, employers would be allowed to make contributions on behalf of employees faced with this dilemma, even if those employers do not make retirement plan contributions. Employers can match the amount of student loan debt repaid by the individual worker each year into their plan. This could be a great opportunity to provide a real incentive for businesses to attract and keep younger employees and help them set up for their future. It also permits retirement plan service providers to offer automatic portability services. Transferring an employee's low balance retirement accounts to a new plan automatically when they change jobs. This change could be especially useful for lower balance savers who typically cash out their retirement plans when they leave jobs. A few other items I'd like to mention here. The current Savers Credit Program allows those meeting lower income thresholds to claim a tax credit for contributions made to Workplace Savings Plan or IRA. It was a non-refundable credit, but effective in 2027, this credit is being replaced by a Savers match. So the match will equal up to 50% of the first $2,000 contributed by an individual to a retirement account each year, or up to $1,000. This will be a federal matching contribution deposited into the Savers traditional retirement account. Obviously, details of how this will mechanically happen need to be worked out by 2027. IRS, good luck. Secure 2.0 introduces the concept of tax-favored emergency savings accounts. Employers will now have the option starting in 2024 to offer non-highly compensated employees pension-like emergency savings accounts, and will have the option to automatically opt their employees into these accounts at no more than 3% of their salary per year, capped at no more than $2,500 per year. Contributions must be made on an after-tax basis. Studies have shown that 50% of all Americans have under $500 in emergency savings. Way too low, and this surely could help. The current tax code imposes a 10% penalty for distributions taken from a retirement account prior to reaching age 59 and a half. Secure 2.0 expands the circumstances where penalty-free withdrawals could occur. Beginning in 2024, individuals may withdraw up to $1,000 per year penalty-free from their tax-deferred retirement accounts to fund unforeseeable or immediate financial needs relating to personal or family emergency expenses. In the past, such withdrawals would typically be subject to an additional 10% early distribution tax. Please note that only one distribution of this kind can be made every 3 years if repayment to the account doesn't occur. There are also less punitive rules for those needing to access retirement funds under certain other circumstances, such as birth or adoption, hardship, of which you can now self-certify, or if there's a terminal illness, and more. Basically, the law makes it easier to get at these retirement funds penalty-free when one really needs to, whereby hopefully getting an employee to invest more in their future. Kind of in conclusion, these are just some of the key provisions from the new law, which is one of the broadest pieces of retirement legislation in decades and includes some 300 plus pages. As you have probably gathered, the Secure 2.0 attempts to help reduce the overall retirement savings gap that currently exists. Rules around retirement savings and retirement plan distributions have changed and will continue to change and evolve over the course of the next few years. To understand if and how these changes apply to your specific situation and for help with next steps, please reach out to your Fairport Wealth Advisor. Happy savings. Bye-bye.